Good morning, folks, and welcome back to Almus Market Mornings. While the Hormuz tensions rumble on in the background, a few macro developments elsewhere are worth pausing on this morning. Over in New Zealand, inflation has come roaring back, accelerating to 4.1% in the second quarter, its fastest in more than 2 years, and well above what economists were expecting. Trade tensions are flaring up once again, with Trump administration threatening a fresh 50% tariff on select Canadian goods, everything from dairy to hockey equipment, though they have spared the big resource imports like energy and critical minerals. And in the UK, new Prime Minister Andy Burnham has already unnerved the bond investors. The long-dated gilt yields has jumped to their highest since late May after his comments on seeking flexibility around the fiscal rules. A lot of updates to cover. Good morning, JK. How are you reading all of this, and which narrative do you think markets would be focusing on for the rest of the week?
Undoubtedly, Swaraj, the developments in Middle East is my maximum attention and the market's attention too, because the uh, escalation has continued and there is more threat to oil supplies. We know that the Strait of Hormuz is already highly disrupted, and now Iran is looking to open a second strategic lever by activating the Houthi allies around Bob El Mandeb Strait, putting more pressure on global energy market supplies. This will uh, is likely to see the oil supplies being further constrained, and it's one of the major alternate routes through which Saudi Arabia also supplies oil. So with Hormuz already disrupted, the Red Sea has become a critical alternative outlet, which is probably getting a disruption again. Of course, you also mentioned about various other, kind of uneasy developments. New Zealand saw its prices go up by 1.5%, the retail inflation in the quarter. But that is mainly driven by petrol prices jumping by 27.5% and diesel prices almost 71%. And they also fed into other costs. New Zealand already raised rate by 0.25% last month, and I think they are likely to raise again when they meet next. As far as the tariffs on Canada is concerned, I think the president perhaps was waiting for the World Cup to be over, as it was jointly hosted by Canada, USA, and Mexico, and he's pointing to Canada's discriminatory treatment to American exports. Again, the tariff thing is that's something that's not likely to die down very easily. And as far as the UK was concerned, from the new prime minister took over, what the market was looking for was a plan for higher growth that will help keep the government finances in a better shape. But what they got was, some sort of statement from him saying that there will be greater flexibility in fiscal and potentially higher government borrowing. That's why the bond markets got a bit nervous. Investors are seeing the government is leaving room for higher spending. But he's also saying that he was looking at raising tax-free personal income allowance. So again, not good for the bond market. And bond markets are already under stress because of oil price rising now. Yesterday we had a big rise once again in the US yields also across the tenors 2, 10, and 30 as the oil prices rose once again. Now, quickly, the CPI, PPI led, price corrections, or rather the inflation correction has been forgotten. Market is once again looking to, these other factors coming into play. However, the UK Prime Minister also named, and John Healey as the new finance minister. That gave some relief to the markets, and they are actually looking ahead to what he's going to say. Now, back on the, Middle East, there was an intraday correction to oil prices yesterday when, mediating countries like Qatar actually proposed a 10-day truce and end to shipping restrictions through the Strait of Hormuz. But IRGC has shown little interest in the proposal. and the core dispute over who controls the strait continues. And even if a temporary ceasefire is reached, investors appear to be viewing it as unlikely to hold, going by the recent stance that is taken by US and Iran. So the geopolitical risk will remain embedded in the energy markets, no doubt. So now the fear is that, yesterday we already hit $91 on the Brent, and perhaps staying here for some more time between 80, 85 and 90 on the higher side. Fear will be that market will once again test the 100 mark level. And at the cost of repetition, I have to say that, now we are not in a position that we were 3 months back. And the SPR, the strategic petroleum reserves, have been used up substantially, and new supply constraints is going to be a big problem for the global energy markets. So that is something that we will have to be mindful of. Yesterday, even all the markets were somewhat under stress. Stocks, in US also initially somewhat, positive, particularly in the Nasdaq, but they gave up the gains. Again, market is looking ahead to a sea of heavy data schedule coming week, the GDP and PCE, big tech earnings, and then central bank meetings also are coming up. This week we have the ECB, next week we have the Fed and the BOJ also coming to the second meeting that's going to be chaired by Kevin Warsh. So a lot to look forward to as far as the market is concerned. So I think now the volatility in South Korean market, where there has been unimaginable kind of leverage that the retail investors have adopted after seeing the big gains in the market, and then the lot of wealth erosion has happened after the authorities have clamped down on those leveraged positions. So I think this volatility is also spreading somewhat to other markets. So we are in a very highly disrupted market conditions right now, and not surprising that the rupee is also slowly seeing new cycle lows every day, not the all-time lows, but definitely not very far from it. Yesterday we also crossed 96.52. But then, of course, there was some intervention. Again, the question is how much more intervention RBI will be able to sustain because of their current reserves position, which is much lower than what it was about a year back. Meantime, RBI also gave some sort of a white paper on what amount of FCNR deposits have been collected. Now, according to their report, banks have collected more than 17 billion in FCNR, and including other schemes where RBI is providing, easier swap facility, particularly for the foreign currency loans, etc. They have collected more than 20.7 billion since the announcements were made. Of course, we have time till September, till when these schemes will run. The worry for the market is if they have collected 20 billion, why the rupee is still tending towards all-time low. Of course, one reason, of course, is the renewed tensions in the Gulf. The other is that I think most of these flows, in some way or the other, have been, either absorbed by RBI, or the outflows, the other outflows like defense and debt repayment by the government. These have been met out of these, and import demand has also been higher after we crossed 95, 50, and 96. So far, whatever number, the 20 billion is not a small number, but still that has been absorbed. That is also somewhat worrying, because if 20 billion has not made an impact on the rupee, then how much more we are going to collect and how much impact it will have on the rupee to strengthen is the question the market is dealing with. So I think there is very little incentive for the dollar rupee to get sold off in the current scenario, be it global or domestic. So we have to live with the market pushing the USD INR higher and RBI resisting it in some way or the other. Thank you.
Thank you, Jack. And yeah, for the rupee, the story just does not seem to turn, even though we have received substantial flows via FCNRB. It seems that it has majorly been absorbed. We are again at I mean, 20 or 30 odd paisa from the all-time low levels for the rupee. So there is a tendency to weaken globally. Also, situation does not look quite positive. There's a lot of volatility, especially South Korean markets. I'm sorry, after the deleveraging resulting in a very choppy and sharp moves. Stocks in general in US have gave up some gains, and now we have a lot event-filled week. So central bank meetings, ECB next week, Fed and BOJ meeting the week after that, and the earnings season that are coming up. So a lot to look forward to, along with the geopolitics that's been the driving force for the markets. That's it from us today. Thanks for listening. We will catch up tomorrow with a fresh round of updates.